What is up, everybody? It's your boy Sean McLaughlin at Option Sean on the old Twitter X. As you can see, I'm not in my home office. Do you recognize that little thing right there over my shoulder? That's the Sphere in Las Vegas. The Sphere. I've got an amazing view of the Sphere out of my hotel room window. Uh, it's getting late or it's getting light now. It doesn't look as impressive as it does during the nighttime, but holy cow, what a amazing view. Anyway, this is the What Are My Options show, guys. And how you doing? The market is oh, getting rippy the last couple of days. Um, if you are trading a lot of high beta names like I am, this has not been fun. But this is part of the course, right? This is what happens when when you're trading high momentum names, high beta names. You're gonna have times like this. This is not fun. But look, this is an open office hours type session here. We don't have a plan. I'm really here to take questions if you have questions. If you're considering a trade that you need some help with, maybe we could walk through some different options, so to speak, to trade that using options. Um, if you need help understanding how certain strategies work, you can ask me that. Or this could be a really quick session if you want. I'm at a conference here in Las Vegas, and I'd be happy to get back to it. But no, I've been trading. I've been busy this morning. Um, so whatever's on your mind, type it into the chat. I'll do my best to tackle that stuff. But let's pull up. Let me pull up on my chart here real quick while we're waiting for people. Let's just bring up the old VIX. It's interesting that the VIX has, I don't know, more or less just collapsed over the last 3, 4 days. Because if you're trading high beta names like I am, it certainly feels like volatility has really picked up, right? When we were up here on October 16th, up pretty high, my portfolio was doing okay, but it really got swamped over the last couple of days. So it's funny to see VIX doing that. If we look at a higher level charts here, let's look at the S&P. I mean, S&P is just barely off of highs, right? Today's red candle doesn't seem all that alarming. Let's look at the QQQ. Similar story. It doesn't look all that alarming right here, right? But this is what sector rotation looks like, right? Uh, the high beta names or people rotating out of that, they're putting money elsewhere. I mean, I did add some stocks, add some positions today and some I don't know if you'll call them defensive. They're not defensive, but like I bought like Duke Energy in one of my accounts today. Um, this thing is looking pretty good. I bought Pepsi today in another account. Who knows where this thing's going, but these are the kinds of names that are ripping right now. It's not the robot stocks, it's not the satellite stocks, it's not the AI plays. They're all just getting wrecked, right? I mean, let's just look at Rigetti. I mean, this thing was a darling, right? This thing was up at $58 just a few days ago. Thing's been almost cut in half, right? What are some other names that have just got wrecked recently? Uh, WBD. No, this one's doing well. I'm in this one. This is good. You know, one thing I do want to talk about here, feel like this could be educational. Oh, by the way, I'm looking in the chat right now. Jackson, I saw your comment. I was drinking with JC last night. I did not. Well, actually, I did. Well, I don't drink, first of all. So let me just put that out there. I don't drink anymore, but I was at the bar with JC. We did a happy hour in Vegas last night and did get to hang out with him for a little while. But then he had some other things to do. But it was fun. Got to hang out with a lot of people. But anyway, I want to talk about, and I wrote about this earlier this week, or was it end of last week? It was earlier this week. Um, I wrote about changing tactics in a market that is potentially changing right underneath our feet, right? What's been working for us, at least as options traders, what's been working phenomenally well most of I mean, it's basically since the April bottom, right? We had the tariff tantrum in April. Stocks got destroyed for about what, a week, it felt like. And then when we hit that bottom on April 7th, I believe was the date. You can see it right here on the Apple chart, April 7th, April 8th, right? When we hit that bottom, The move from then, from April till, recently, if you're an options trader, has been just simply buying calls. Buying calls, maybe buying some call vertical spreads on expensive stocks or super high volatility, but just keeping it simple has been the strategy that has worked for options trading, right? And that's great. I love just buying calls. Buying calls to express my bullish ideas and buying puts to express my bearish ideas. That's great when the environment rewards that type of behavior. I love it. I love it. And that's what we've been doing. I mean, yeah, we've done other trades, done some calendar spreads and things like that, but the trades that have really worked and that we've done a lot of have been simple calls and puts, long calls and long puts. But as the market changes, right, which we may be seeing now, you got to change tactics. And so I wrote about how in an environment where you start to see some downside volatility, starting to see some stocks selling off a little bit, and volatility rising, one new tactic you might consider employing, especially if you don't think the market is, if you the bull market is over, but you think that we are in for some, volatility perhaps, don't forget about the old short put play. All right. Now, I know selling naked short puts can be scary to some people, right? It's theoretically unlimited risk. The stock could go to zero. That's your floor, right? But the risk of being a holder of a naked short put is no different than owning stock, right? Would you be nervous holding 100 shares of Apple? Maybe, maybe not. That's no different than selling a naked short put, one naked short put, which is equivalent to potentially owning 100 shares of Apple. But when the market's rewarding that type of trade, you got to start looking at it. So we did one in Apple recently. I wrote about it. I'm rehashing this for some of you, but when we had this big red candle here on October 10th, I told All-Star Option subscribers, I said, hey, Apple's pulling back. It's a big, ugly red candle, but it's got some nearby support that we could lean against, right? This was previous resistance here around 240. I thought that could come into play, support kind of from where we broke out in mid-September. We had a rising 50 period moving average coming up below it. So we had a couple reasons for Apple to dig in here. And at the 240 strike down here, or, I'm sorry, 235, there was a lot of premium to sell puts. Why? Because volatility is rising as Apple was selling off, which is pretty normal. When stocks are selling off, people get scared and they bid up the prices of options because options can be protection. And so the 235 puts, I was able to sell them for 465. But here's the thing. You have to have a plan, and you can't just sell naked puts on anything, right? You need a couple things to work in your favor. Number one, you want high premium, which we were getting that in Apple, relatively high premium. Okay. Number two, you want obvious levels of support that we can lean against. That's very important. And number three, you want to sell naked puts in big cap stocks or ETFs. Okay, stocks that are unlikely to have a large gap against you. Okay, sure, Apple can have a large gap. It's happened, but it's unlikely, right? It's unlikely, especially without an earnings event coming up. We didn't have any earnings to worry about with Apple. So when you put these trades on, these are not home run trades, okay? When the market is not rewarding home run trades, you don't put on home run trades, okay? You put on the trades that give you better odds of success. And a short put trade, by definition, if you're selling out of the money puts, it has a higher odds of success than, say, buying out of the money calls. But you're not going to get paid as much, okay? This is not a home run trade. The most you can make is the premium you collected on these short puts. So if I sold them for 465, right? The best I can hope to do is to make 465 because what will happen is I'll sell these puts for 465 and I'm hoping the puts just expire worthless. And if they do, I keep that 465 I collected up front, free money, right? 465, the multiplier on a put contract is 100. So that's $465 per contract I collected, right? Now, I don't make it a best practice of selling out of the money puts and then hoping they expire worthless. I get a little bit more active. I'm not greedy. I take money off and I can buy it back for half of what I sold. That increases my odds of success. It increases my likelihood of winning. Yes, I win less, but I'm going for a high batting rate here, right? When I sell naked short puts, if I sell, I don't know, 10 of them, I want to win on at least 8 of them. That's my goal. Okay. And so I sold these things at 465. My plan was to buy them back at around 230, half of what I collected on day one. I was actually able to buy it back at 210 because Apple had a nice little gap there. So it opened up cheaper than I would have been willing to buy it at. So I bought it back and closed it for 210. So I made $2.55 in 7 trading days, right? That's what you want. And by the way, when you're doing short puts, or any short premium play, you generally want to position in the expiration series that's about 30 to no more than 60 days expiration. Why? Because once you're inside 30 to 60 days until expiration, that's when theta decay starts to really kick in your favor. Options decay. All else being equal, if an underlying did not go anywhere, the stock was unchanged on the day, all else being equal, the value of the calls and puts, certainly the at the money calls and puts, well, all the calls and puts will lose a little bit of money. That's theta. That's a time premium, right? And as we get closer to expiration, that time premium, certainly in percentage terms, accelerates. So we want to be sellers of options between 30 to 60 days expiration so you can get the most meat and then catch the accelerating decline or the accelerating theta decay to help you in your position. And for this Apple trade, I mean, it worked pretty well for me because I got the direction right. However, I didn't need Apple to really go to go higher and make a new high or new cycle high there. All I needed to do is not to go down much lower, right? The stock was trading at around 245 when I put this trade on. As long as we stayed above 235, which is the put strike that I sold, as long as we stayed above 235 and we never violated 235, and eventually those puts are going to lose value and come down to my price target where I wanted to buy them back because those puts are on their way to zero, right? So when you put on a short put trade, you don't necessarily need the market to rally. You like it. If the market rallies, that makes it easier to get your profits. But the bet you're really making is that the stock is not going to fall, right? Is that a bullish bet? Sure, but it's really I'm not that bearish bet, right? And so this is a trade that you can use in an environment like this. I think for the next few couple of weeks, I would think that if we find some big cap stocks like an Apple, like a Microsoft, like an Intel, like Nvidia, like Cisco, like IBM, like Berkshire Hathaway, like ExxonMobil, just think of the big names, right? The biggest names you could think of. If you have some pullbacks, let's see if we can find one here. IBM, some good candidates. If anybody has any good big cap candidates, throw them in the chat. We'll look them up. Microsoft doesn't look all that great for a candidate here. Burke B. Let's see what that looks like. Okay, here's one. Kind of sitting on some support here. This one could be good. Let me pull up the volatility chart. I'm going to change charts on here real quick. Because we want to factor in volatility, right? So here's Berkshire's not really a good candidate right now because look at this on the bottom of my screen. I'm showing the implied volatility chart. And the implied volatility is near the lowest levels it's been all year. We had a spike in April when everything else spiked, of course, but right now implied volatility is pretty low. Not a good candidate for selling puts. You want this blue line to be in the upper half of the range of the year. That's a good place to go fishing, right? When we sold those puts in Apple here on what was that, October 10th, we had seen a little bit of rise, not a high rise, right? But we've been rising right on this day. I was like, okay, that's some premium to sell. Let's do it. All right, Jackson, let me check out your tickers there. Crowd, you liking Crowd? Ooh, that's a good looking chart right there. Right? In fact, that's such a good looking chart that I'm going to put a little alert in here for myself, maybe right above this recent resistance early last week, because this is a name that I would like to buy. If we break above, around the 512 area, I mean, this looks like a classic cup and handle, right? The old IBD folks. In fact, I hung out with my friend Joe Fami this week in Las Vegas, and he's a big disciple of Investors Business Daily. William O'Neill, the William O'Neill school of thinking, and the cup and handles their classic pattern. This is one of those classic patterns. I like it. I like it. This is not a good short put candidate. This would be a candidate for buying calls. Why? Look at the supply volatility, very low at the lower, at the lower end of the range. So that means options premiums are going to be pretty cheap. Now, this is a high priced stock, right? We're talking at stocks at a 500 handle on it, which I hate stocks that have 500 handles, but we work with the market we've got. So yes, if you have a large account, you're not gonna flinch at buying some calls. Like if we looked at like if we wanted to give ourselves some time, like 6 months, look at the March expiration. I mean, look, if you wanted to buy an at the money call, you're gonna spend probably $55 to buy that call. That's $5,500 per contract. That's about 10% of the value, a little bit more than 10% of the value of the underlying, right? That's no, that's five. That's 1%. Excuse me. No, it is five. It is 10%. Yeah, 10%. Look, if you have a large account, that's fine. I mean, one thing I like to do, guys, you guys know this, when I'm trading long calls or puts, simple long calls or puts, I want the my outlay, the cash I pay for these calls or puts to be no more than worth, no more than 2% of the value of my portfolio, but ideally less, especially when you're trading with options. Targeting 1% or lower, if you can, is much better. Because when you buy calls or puts, it's a very high likelihood that you can lose everything, right? These are leveraged instruments. And don't let that scare you. Just let position sizing be your superpower. Never size big enough that you could lose more than 1% of your account if the thing goes to zero, right? So if you have a large account, you could trade these CrowdStrike options and not worry about it. I don't recommend buying the at the money, but maybe you buy, you know, the 600 strike. They still have a 33 delta, right? But that's going to cost you $25. But what you can do is you can buy call spreads, right? A call spread is you buy, let's say, an out of the money call and you sell a further out of the money call to lower your cost. So let's check what this would look like. If I wanted to buy a vertical spread, so I'm buying the 500 call, let's sell the 600 and see what happens. So right now, the buy to 500 call, it would cost me about $58, right? Well, if I buy the 500 call and sell the 600 against it, instead of paying $58, I'm now going to spend about 33.50. Okay. Still a lot, but I've cut my cost almost in half, right? Now, my gains will be capped, right? If CrowdStrike goes up, rips higher and blows through 600, well, I'm not going to participate in any gains above 600. The most this spread could be worth is $100. That's the distance between the strikes. I bought it at 500, sell it at 600, or bought that. Sorry, I'm long the calls at 500. I'm short the calls at 600. The most that spread could be worth is $100. I'm paying, if I were to buy this right now, I'd pay about 33.55 for it. So my net profit that I can make is about $66. That's it. I can't make any more than that. Now, if CrowdStrike goes on to $1,000, I'm going to be pissed that my gains were capped. But I didn't pay as much to participate. That's the drawback. Here's the thing with options trading. I say this all the time. There's pros and cons to every strategy, right? And there's no perfect answer. And this frustrates traders, options traders to no end. They want the right answer. They want to choose the right answer every time, right? You can make the right choice in binary things where you're just buying or selling futures, right? It's pretty simple. You can either buy or sell. With options, there are a lot of different things you got to factor in. You got to factor in volatility, you got to factor in theta decay, you got to factor in time to expiration. There's lots of moving parts, right? There's no perfect answer. I might buy a call, you might buy a call vertical spread, another guy might buy a call calendar spread, and we could all be right. And one of us might be more right than others, but I took on more risk to do that trade, perhaps, right? So there's no one right way to trade options. There's lots of ways to do it. That's kind of what I like about it. I like having options. Options give me options, I like to say. And it's always it's a puzzle to put stuff together. It's fun. All right, Jackson. Yeah, yeah, yeah. We hung out with Joe Fami yesterday. It's his birthday this week. His big party's on Friday night. Unfortunately, I'm not going to make it. JC's not going to make it either. We're both flying out of here today. But we got to wish him a happy birthday. I got to be on Joe's podcast too. You guys can look forward to that next. I think it's coming out this weekend, maybe. I don't know. We recorded yesterday in the studio. That was fun. But Joe Fami, one of the best. All right, guys. Anyone have any questions? If you don't have any questions, then we're just going to cut this off because I've got things to do here. My friend Josh Brown is about to. I think he's hitting the stage right now at the conference. We're at the Stansberry Research Conference here in Las Vegas, and I got to see Josh last night. He was hanging out with us, and he's hitting the stage right now. So if nobody else has any questions, I'm going to go see him talk because he's got some cool stuff to say. And oh, the other thing too, I'll say is, we haven't done what are my options in a minute. It's been a couple of weeks. I've been on vacation. I've been traveling. Boy, this October has been the wildest month for me travel wise. I've been all over the place in every single time zone. It seems like I've been from Hawaii. I'm going to the East Coast this weekend. But once I get through this weekend, I've got no travel on the calendar until February. So, whew, everything's going to get back to regularly scheduled programming, which is good because trading's getting a little busy as you've all noticed. All right. Oh, GSK. Sorry, Jackson. GSK. What do we have there? Check this out. Why can't I? There it is. GSK. Hey, I mean, similar looking chart to CrowdStrike, right? That's a similar looking chart. I like this setup too. You're dealing with rising volatility here, so you're going to pay up for the options most likely. They've got earnings coming up. I can see that those are earnings are due any day now, next couple of weeks. Earnings might be the catalyst to send this thing higher, right? I'm gonna put a little alert here for myself just to keep this on my radar. I do this a lot, guys, by the way, and hopefully you have a trading platform or charting platform that allows you to do this too. When I see charts that I like, I just put in a little alert on there. If it breaks a level, it doesn't mean I'm going to necessarily put a trade on, but I might. I might put a trade on. So I love this. But GSK looks good. Volatility is rising, so that's something to be afraid, not afraid of, to be concerned about. Doesn't mean you can't trade it with just calls. Let's look at what the calls cost right now, just for argument's sake. If we were to look at, I don't know, let's give ourselves to January. It's 3 months expiration. Okay. I mean, look, if you wanted to like just keep it super simple and buy the just out of the money calls, basically the at the money calls, the 45 strike, you could buy them right now for a buck 85. That's not terrible. If you want to jump that move, like if you're pretty confident that that move is coming, buying those 45 calls for 180, what was it? 185? What did I say? Yeah, 185. That's not a bad trade. And that's all you're risking. Guys, the thing about options when you're buying calls is your max risk. If I pay $1.85 for these right now, that's the most I can lose if I'm dead wrong. If GSK has an earnings report that disappoints and the market's not happy and the stock craters, I know the most I'm going to lose is the 185 I paid today. And like we were saying before, I'll size my position in a way that I'm okay losing that. Okay. It's not going to be, it's going to be 50 basis points of my account or 1% of my account at most, right? Ideally less. I like this chart there, Jackson. Yeah, I'd like to see it, kind of break today and yesterday's highs at a minimum, get up at least above 44.50 before it got involved, but that's a good looking chart. And just, pay attention to the implied volatility. I wouldn't expect implied volatility to rise much higher than here if we break above, yesterday's high. But we'll probably see it drift a little higher as we get closer to expiration. So that's just, or not expiration, earnings. So it's something to be mindful of. Okay. But hey, I've come around to this, guys. I've written about this in the past. I started my career as a stock trader, as a day trader, right? Or a day trader, and sometimes I would swing trade some things. And I learned the hard way early on that as a stock trader, I don't want to have positions on heading into earnings because I can't manage that overnight risk, right? If we have a huge gap, I'm going to suffer the loss if it goes against me. Sure, it can go in my favor, and that's great, but the other side of that knife is pain, right? So, as a stock trader, I learned to avoid all positions leading up to earnings. I didn't hold any positions overnight heading into earnings. I've carried that into my options trading for a long time, to my detriment. I finally come around over the years. I've realized that, Sean, you know this. Options give you the ability to define your risk. So why not take a shot in a stock that's heading into earnings if you have a good feeling about it? If you like the setup or I don't know, you have you've been reading the tea leaves of the earnings reports or the earnings estimates, and you've been reading all the research, and you have a feeling that the market's going to like what comes out of the earnings report. Great. Why not trade it with options? Why not be long premium heading into an earnings report, knowing that if you're dead wrong, you know your max risk? That's fine. A stock trader can't say that, right? A stock trader, he or she may put a stop loss in their order, but if the stock has an overnight gap and it's through your stop loss doesn't matter. You're going to get filled at the opening price, whatever that price is. It could be way below your stop. That makes me uncomfortable. I don't want to do that. But with options, at least we know what our defined risk is, and we're good. All right, ladies and gentlemen, this has been fun. We're keeping it short. We don't have a whole lot of questions today. I think everyone's a little, gun shy with the market. It's been hard the last couple of days. It's certainly been hard for me. I feel you. I feel you. Um, I'm gonna get back to the conference. If you have any questions, you can hit me on Twitter or X, options Sean. You can always hit me up there or shoot me an email at All Star Charts, Sean at allstarcharts.com. Hit me up. Happy to answer any questions you have there. And I put in the chat there at the top of the chat. Subscribe to my free newsletter. I've been traveling a bit as over the last couple of weeks. It hasn't been a daily newsletter because I've just been busy, but the goal is to kind of make it every most days. And we're trading education, or we're sharing educational bits, anecdotes from the real world of trading, all kinds of stuff, and it's free. So why not sign up? And if you want to get involved in All Star Options, please do. The link is there as well. Detailed trading plans delivered to your inbox multiple times per week, and a whole community behind it. Live chat room with me and everyone else in the community. Love to have you. All right, everybody, have a great rest of your day. I'll see you tomorrow with the options jam session. I'll be back in my home office tomorrow, as I'm flying home tonight. So back to the real world in my office, and we'll review action in the portfolio of all-star options. We've had not a bunch, we've had a few exits since we spoke last week. So there's lots to talk about there. We have some stops to update. We'll talk about some of the new positions we put on. Everything all-star options related. So tune in tomorrow. I believe we're doing that at 3 Eastern tomorrow. You can find it on the website. I'm pretty sure it's 3 Eastern. All right, everybody, take care. I'll see you next time.